All right, everyone, welcome back to Capital Mindset special video episode, whatever we want to call it. This is going to be a discussion about REITs between just members here on Discord. So I ask everyone who's listening in on the side to refrain from, commentary, just me and the individual who will be discussing today. Also refrain from making the, reactionary emotes. All right, so let's begin. Kingdom of Finance, take it away. So what's up with REITs?
The issue is it's specific REITs that will continue to outperform for a very long time. And that's my personal take is office REITs are the lowest forms of REITs to be investing in. Think of them like as I would compare them to like life insurance companies. Very low quality. They'll have now a permanent stagnation. And when we look at specific REITs like KRC, I don't think they'll be able to convert properly into life sciences or like other forms of real estate as well. Um, Way too good's asking if you want to use
Yeah, no,
soundboard. But
no.
that's my opening take on it. Office REIT specifically, pretty hot garbage. And then when we look at the more mature ones, like I like V&Q, but I even think V&Q will also underperform moving forward due to the nature of the sheer size for a lot of those REITs. Like I like American Tower, I like Crown Castle, I like Prologis, but these things are already so massive. How much more big can they really get? Is obviously if you said that about Amazon or back in the day, then obviously right. But I just don't see the performance for them moving forward. And REITs and then the distributions as well, they're not linear. It's not like you see a linear growth. Very cyclical in the way sometimes it's a bit more cut, sometimes there's more of an increase, yada yada. That's my opening take on that.
I will actually concede the point to you that there is a scalability question, but sometimes our minds aren't capable of grasping the true vastness of what real estate is, like the whole real estate market. I almost present the question or the point in almost a concern because these entities are so well capitalized, so low leveraged compared to individual investors or even private syndications that I'm almost like, how can anyone else win but them? And that's getting into a broader concern, but kind of almost saying like through every downturn, I expect these monsters to get even larger. And it's scary to even consider that because it's like we're already at the point where the like you're pointing out correctly, right? American Tower, they're really big. How much bigger can they get? Well, look at the total market for that. And it's like these smaller players who are way more leveraged than they are. That's the part where I'm almost like concerned for a separate reason, aside from the investment perspective. Um, saying like, what they're gonna just gobble up everything and they're just gonna own all the land. Like, okay, I'm not sure if I want that, but like looking at realty income, this monster, like I can't personally, and I concede that point. I can't imagine that they can find that many good deals. Like it's tough to scale. It's not like a software. It's not like Amazon. And I don't think they're going to get like Amazon. But in aggregate, right, there are strong advantages that the asset class as a whole has. I will push back, obviously I'm biased here, that office is to be thrown out. And going more specifically unpacking KRC, I would push back again. The audience should know I'm biased because I hold a position in KRC. So I push back on that only because within the office space as a whole, I think that the asset class is not going to be absolutely demolished. I point out, or I want to point out to everyone that look at the cyclicality of the sector, and it's cyclical, and we're going through a cyclical downturn. We're coupled with an additional disintegration of sentiment because of work from home. So I think that's the added opportunity here because if I look at other markets, I look at how they've returned relatively back to normal. United States is lagging. And if that changes, you got a very interesting opportunity. Now, that's why I've advocated for not getting exposure to the less capital or the less pristine capitalized entities. Specifically, when it comes to mind, there's Vornado, for example, SLG or SL Green. Boston Properties and KRC is the realm of which I want to play. KRC is a bit more on the riskier side than Boston, only because it's geographical exposure, which I'm going to give it back to you because I don't want to rant a lot. Am I correct in saying, and I would like you to expand upon it, the geographic?
As as I would like to call California, go woke, go broke. So I think California is the lowest quality of state to be having any sort of REIT exposure in. Personally, if the office REIT exposure was, let's say, Texas, a growing state, growing economy, and you're seeing some decent exodus from corporations to have their headquarters in Texas, yeah, I'd be a lot more bullish. In, let's say, if KRC, the most of their exposure was in Texas, you'd probably be seeing me quietly have KRC in the portfolio. But unfortunately, most of it is, in the state where the governor is run by what's that guy's name? Gavin Clown. Yeah, Gavin
Newsom.
Clown. The clown. You got San Francisco, which is hands down worse than Bangladesh. Like a horrible city. And you're seeing massive exodus for a lot of local businesses that simply have to shut down because they cannot afford the new laws that are being placed there. The 1,000 law. I think we all know about that one, right?
Yeah.
Yeah. So we got that aspect of it, and then my other rebuttal is why not REITs like Alexandria, which has more. It is pretty much the pure play in life sciences, and I would perceive that as more higher quality. And again, yes, to that point, there's a lot of them that are leveraged. As they collapse, I can view Alexandria, which is, by the way, 20 billion market cap. I think they'll probably go a bit lower. I view them as kind of like waste companies where you're going to see a lot of their competitors collapse on their face, meaning that the companies like Alexandria will actually have pricing power moving forward. So I rather be investing in something like, if I was going to be investing in some REITs, especially in the office side, I rather have that exposure in Alexandria than having this nonsense California exposure, worshipping Gavin. And again, keep in mind, it's not like a lot of the stuff that KRC has will be able to convert into life sciences or other forms of real estate, right? It's office. And again, corporations are massively exiting California as we speak. So there's my take on that. Trash REIT, by the way. So.
And the thing is, we don't disagree there on the quality of ARE. In fact, there's a write-up on Alexandria Real Estate. For some added context, anyone watching this in the Discord, because this video will be available to both gold and non-gold. So this is a write-up that's found in the Investing Ideas write-up, where I shared. It was actually originally written up by Austin. And you guys might know Austin as Lord Spornsburg. But I added to it with my own analysis, basically adding that Alexandria Realty is really likely to perform really strongly because, as Kingdom just pointed out, it's absolutely correct. The life science exposure is fairly attractive. The business model of life science is really interesting because what they focus on is exposure to a lot of these university research facilities, that universities have to have this spending in order to qualify for being nonprofits or universities, institutions of education. So that gives Alexandria Realty almost a surety of those cash flows because they're a necessity for the universities. And KRC is expanding in that vicinity. But my kind of counterpoint, like the reason why I wanted to go for KRC, I liked the fact that it was hammered in addition because of its California exposure. Because if I look at them versus Boston Properties, there's a larger discount for KRC to Boston Properties. So my play here is playing against the I think over pessimism of California, because I think California doesn't have as much of a growth prospect as something like Texas or Florida. This is coming from someone that has lived in both now Texas and Florida. And I'm very bullish on those states, but I think that I'm more of politically, I don't rank or I don't align myself really with California politics. I don't want to even make it sound like I do. But I also like to think of myself as someone who tries to come to the table with a cool mind. So, for example, I'm not going to get political here, but like, for example, I don't consider Joe Biden a socialist. I don't consider Trump a fascist. I do take more or I take more nuanced approach to like those terminologies, and I apply more of a literal definition or a literal application to those definitions. And so also kind of being Venezuelan, I think maybe I'm more of like, okay, I know what real socialism is, and Joe Biden's not that. And even I would say Gavin Newsom isn't there yet at all. But so I'm looking at California. I'm saying, yeah, it has all these issues, right? And I think it's priced appropriately. So I looked at Essex Property Trust as a residential play in there, and an office, mainly KRC. I come back to it again, and I say like, well, KRC's leverage really isn't bad at all. It's relatively conservative. So I'm attempting to capture in that investment. And by the way, I'm gonna, again, I don't want to rant too much because I want to give Kingdom plenty of time to speak. I get from our conversations you have an additional disdain for KRC because I think certain retail investors like really just picked it up. Am I correct?
Yes. So long story short, for those that don't know, I am starting to, thanks to certain people like Dan, I am starting to, because my investing style has been pretty similar for the last couple of years where I like shareholder friendly companies. Like when we have discussions of cybersecurity, I preferred Fortinet because their SBC wasn't egregious and they were doing buybacks and everything was good there. So similar situation here. I don't like the fact that you're seeing a lot of retail yield chasing and KRC, guess what? 8% and 8% yield, and lo and behold, everyone's now talking about KRC. And I try to avoid stocks that retail loves because once that happens, kind of know, Wall Street and the big boys, they're probably not in those stocks. Obviously, there are exceptions to this, but now PayPal's that popular one. Palantir, SoFi, all that, and I view KRC in that same light. The short interest, by the way, is starting to rise on KRC, so not surprised on that. It's about like 5.42%. And again, I like dividend growth companies. Even for REITs, I still prefer a decent growth. KRC does not have that, which makes sense. But we look at Alexandria; they have had a exceptional dividend growth story for themselves. And due to a sheer size, and we look at the exposure that they have. Eli Lilly, I'm pretty sure Novo as well. A lot of the other health conglomerates, they got great exposure. Alexandria has great exposure to all of them, so I'd rather be investing in something like that over KRC, personally speaking. But I view KRC similar to that of like innovative properties. I view it as like a degen play, nothing you should take seriously. And honestly, my other question is why not, focus on, because again, I think all of us, we have a little benchmark, right, for ourselves. So one person will have a benchmark for maybe like the SPY or SCHD, whatever. And that's what I do. Why should I invest in an individual stock when I can invest in the benchmark, which is the S&P 500? So with office real estate, when we go back to that, or honestly, even the larger ones like American Tower, do you strongly believe those companies will be able to outperform something like QQQ or SCHD or Moat? Shout out to that ETF, right?
Yes, I do. And I'll lay that out, the scenario in which that happens, because I think it shouldn't be a surprise to anyone. When I'm investing, I have like multiple scenarios laid out in my investments. So let me then kind of walk through what the scenario is in which the case the office REITs, or this specific office REIT, because it's the only office REIT I own, comes out really strongly on top. And then what I would do is readjust my portfolio after I believe if the thesis plays out. Adding to that, notice everyone, I think this should be of no secret to anyone. Look at the allocation percentage. Also, it shouldn't be a secret to anyone. I think I've expressed this, that my holding company portfolio is not my entire portfolio. People know that. So even when it was, the allocation was really, I don't know what really the final percentage was in the holding company of KRC. But I think its allocation was relatively tamed, especially when you consider the overall bucket. And then now it's extreme. It's still around the same percentage in terms of tameness. I think it's like at 2 point something. At the high point, it was 3. As it fell in price, it's now at 2 point something. So when I have all these plays around, the scenario in which KRC has a short-term outperformance is twofold. We see rates coming down, which I have plays playing on that idea. And I still believe that. I'm a very strong believer rates are going to come down. The long-term trend for rates is going down. That's not a good thing. I won't get into that macro bullshit, but focusing on what REITs is playing is that REIT exposure gives me exposure to that idea. And then added to that, we have a couple other catalysts that could be really beneficial in that front, which is the return to norm. Where the United States is lagging the rest of the world. We look at Japan, Europe, they've already returned in relatively normalcy in comparison to prior COVID. United States is the weird one. So what's more likely, that the rest of the world converts and goes to us, or we kind of revert back to them? And then I hear every single time from, it's not insider knowledge. That's not the claim here. And all of you can look at this information. It's all public information. We see efficiency is down. Companies or corporations are saying, no, we need to go back. We need to go back. We need to go back. This model does not work for productivity. And so if that coupled with interest rates coming down, and then on top of that, California's not actually that bad, that's going to probably lead to some strong relative short-term outperformance for that specific play. And I think way too good brings up a good point. Well, way too good. My question to you, and I'll read the comment out loud for everyone who can read it. I think we are debating two separate things. You are making the point that real estate / REITs will continue growing. My point is, sure, real estate will grow. No one's debating that they are going to zero. My problem with REITs is I don't believe they will grow more than common stocks, C Corps, especially tech. That's why I like tech. So far, real estate has been the major wealth creator for Americans, followed by tech. I don't believe it will be the same going forward. But my counterpoint to you is, okay, well, I don't know how much more tech I can be exposed to percentage-wise in my portfolio. I think if you grab my top one, I think KRC is my 10th largest holding. I don't know if that's, I'm just kind of doing some pencil math, but I think it's my 10th largest holding, right? And so
Kilroy? Oh no, that's 100%, bro. Come on.
Yeah, no, but no, it's being serious, right? I think it's my 10th largest holding, and then ADC is somewhere maybe closer to that as well. So adding them together, even considering all real estate together, I don't know how much in terms of total percentage of my portfolio is, but I think tech is very safe to say it's like 70, which is, I think, almost uncomfortable for me a little bit. But I'm comfortable with the individual holdings because it's, tech exposure. I consider Netflix basically tech. It's media, but it's like kind of tech. So yeah, especially now. Oh, you guys haven't even seen the update. You guys see the corporate, sorry, not the corporate, the holding company portfolio, and you see how much Amazon makes out of it now. When you guys see the personal update, it followed the same trend. But yeah, getting back to that's kind of why I chose KRC, because Boston didn't capture that idea. Boston captures the thesis of rates go down, return to office. But I wanted even a little bit more. And so that small percent allocation I have can actually return a significant amount to my portfolio if I'm right. And then if I'm wrong, its allocation size doesn't really affect me. Remember, I like to do that. I love to set myself up for that, where if I'm right, the performance can be meaningful. And then if I'm wrong, the drag on performance isn't that bad. And that's where I think KRC is fitting in. Now, Kingdom, if you find someone that made it like a 10, 20, 30% position, I would be on your side there and say that's an excessive amount of risk.
There are people that have it.
And I'm on your side there that that's an excessive amount of risk. But let's say, for example, I do believe it is completely within the realm of possibility that KRC triples. over a short period of time. If you get those three catalysts working together. And then, by the way, they did grow the dividend last year. They went from, let me see.
How much though?
I think it's percentage-wise significant. I think the chart is misleading because there was a special dividend, but it went from 204 to 212, so 8 cents. It's not like crazy amount,
No.
but that's like a 5-6%, between 5 and 6% mental math.
4 or 5, something like that. Alexandria's been just a lot better in that sense, and a lot of those. But the thing is, the reason why I keep mentioning Alexandria, not the larger ones, is just, again, I'm more bullish on Alexandria personally. Because we look at their dividend growth, theirs is it's almost a similar trend too. They're about 7%, but I do think that you're getting a more higher quality play in Alexandria than you are with KRC. And this is my opinion on that forefront, because I do want Eli Lilly exposure, but do I necessarily want to buy the stock itself? Probably not, because I do view Eli Lilly to be pretty expensive, even though their pipeline is pretty phenomenal. But you get that great exposure to Eli Lilly and a lot of the other healthcare conglomerates with Alexandria. So I don't know, man. You can go all in with your KRC, right? Your TTCF, your Oatly, hedge it together. Both are wrong at the end of the day.
I mean, I don't think we've illustrated like the fair comparison between the two. I know it's a joke, but this is my version of KRC. Oh, sorry, TTCF. But I mean, like, it's fair to point out that no one should just get involved because they want to. I do say, yeah, there are people out there, man, that they're not even gonna copy the allocation, which is sad. So they're gonna copy, but they're gonna do their own allocation. I'm thinking of one individual with Tyson Foods. This is like the newest meme, I swear to God. When I had a 0.8% allocation and the person went 10% in. You know who I'm talking about.
Oh my God. So that's another point I want to make. It's not even necessarily you. Actually, way too good. Fantastic point there. But because it's not necessarily.
Can you read out his point for the video?
Can you read it out? I'm just like,
okay. I'll read it out.
Lazy reading, bro.
I'll read it, and then Kingdom will expand upon it. I understand your rationale behind investing in REITs, capital mindset. You may have a $1 million plus portfolio. I understand the need for diversification from tech, but you are not the one we troll here. You just fall in the crossfire, not fail. Fall in the crossfire. The thing is, not everyone here is bailing people with 50K, 100. Oh, sorry, balling. So, I'm not wearing my glasses. People with 50 to 100K portfolios shouldn't even feel the need to diversify into REITs. There are plenty of other sectors in the stock market where you can diversify. People buying $100 worth of stocks are copy trading you into buying KRC. That's degen.
Okay. Yeah. So I want to expand on that. That's what I'm referring to. And again, it's because you defend KRC like your life depended on it. I'm like, okay, I gotta over amplify the trolling capacity for this stock as well. And I love the statements you make. Like you say, I have a key ring, whatever. I was crying laughing with that one. But in general, people with smaller portfolios really shouldn't be focusing on REITs is my point as well. And this is why I like to troll when people, when I see a lot of these people, right? Not just your community, right? It's everywhere. It's retail, right? What retail is going to do retail things. You got a lot of people copying, and they just pretend that they're not copying. Like they found the stocks themselves, and they're just going all in. They don't know what an allocation is like. So they look at a video of Warren Buffett and Cathie Wood both have StoneCo, and they have like a 20% allocation to it. That's pretty goofy. Both of them have it at like a speculation play. I mean, ARK itself is all speculation, but even in the ARK fund, it's a speculation allocation as well, even for them. And then Warren Buffett, same thing for them. It's just a tiny little speculation play. But again, with retail, they look at that. They look that they both have the stock, people that they respect in their eyes, and they're just like buying a lot of it. So their $1,000 portfolio and $100 of that, they're throwing it into nonsense, right? Which should be at a lower allocation, but they're making it a larger one. Like with if we go back to like Tyson Foods, whatever, that's one where I think I mean, because again, I've been looking into agco quite a bit. I like agriculture stuff. I like
Same here.
fertilization companies.
Love
So
it.
I've been looking at those companies aggressively. NTR is definitely a little bit more on the degen play, but I'm looking at it. I'm looking at it. And similar situation. I know what they are. They're commodities. I should treat it as such when I'm making an allocation breakdown for my portfolio. Do I really want to make a fertilizer stock 10%? No, that'd be kind of goofy. 3% is more realistic, is where I want it. But again, people don't know how to allocate accordingly and be, and understanding the risks involved in the stocks that they buy. That's just my personal opinion on that point. And so yeah, way too good. Great comment there. That, and again, so I'm not necessarily trolling you per se, but your simp level of KRC just makes me okay. You're gonna simp on this stock in California. All right, I gotta just like amplify that trolling, to the next level then. But anyways, those were my points on that overall.
I don't think anyone would disagree with anything you said there. Well, that's the thing. I would actually encourage all of you more than to self-police as a community to make sure that people aren't doing that. Because if I feel like I said this, if I felt that that's occurring at a greater occurrence, I will simply actually just stop doing portfolio updates.
Oh man, can I respond to way too good just for a sec? Just
Yeah.
for a sec. All right. He said this debate is so soft. Well, bro, he's not Cole. I'm sorry, man. Like, or Belly Boy. Like, those two just bring a little anger inside of me, right? I just don't have that with the Mexican man. I'm sorry. Like,
Kingdom
with Cole
secretly kind of loves me.
oh, but with Cole and Belly Boy, this hatred just, man, the aura is just pure hatred, like the devil, man.
Oh my
Anyways. Anyways, back to what you were saying.
No, and I really want, so I would love for when people get integrated into the CM community, they get unbrainwashed of cult of personality investing. And the goal of when I show my portfolio is just for a sense of transparency, right? And inspiration, if anything, but not to copy, because I could just as easily do really bad. And I want people to, and I think everyone here in this voice chat has done a really good job of that. A lot of you guys come with your own ideas and counter me, and you guys are showing that as well. Like, so Way Too Good's investing style is vastly different from mine. I mean, we completely different. Kingdom and I's portfolio looks different. We have different positions. Emperor Sauron here has different positions. All of you guys have different positions, different allocations to me. And the point of this community is to share the perspectives. I just take it upon myself to, add more in terms of like showing. But no one is required to do that. Of course, no one's restricted from doing that. Anyone can show their portfolios. It doesn't matter. But yeah, if I ever feel like almost like undeniably that unfortunately is becoming the case, then I will, like I said when I was doing my allocation of meta, if you guys recall that video/live stream, I said that if I ever feel like, I'm almost trusting on a whim that people won't do this. But here it is. I'm showing you my allocation of meta. Don't copy me.
Yeah. Like, let me give you an example for my own personal, investing. So 70% at all times, it's a rule I've had since 2019 to always be 70% index, no matter what. Like if my stocks start outperforming a bit, well, I'm going to aggressively, reamp the index exposure to 70%. Because that happened to me in 2021 where like, some of my stocks were just roaring like in phase. So I was like, oh shoot, okay, I got to aggressively invest in the index. Got to get that exposure up again. So 70% index, no matter what, 15% cash. Not at all times, because obviously 2022 was a fantastic year to buy tech. And I definitely partake in it. More so Meta, but also Amazon and blah, blah. Ooh, play to the soul, blah, blah. But anyways, but now my portfolio is a lot more concentrated for the individual side of it, which is 15%. And in there, Yeah, the allocation can be pretty crazy. Like my one of my largest holdings now is a I won't mention, I mean it's Discord, so I guess I can mention the name. It's unlisted video, right? So it's all good.
Yeah.
But my allocation now it's almost like 40% in ClearVest, right? But keep in mind, that's 15% individual stocks. And I did a lot of research with ClearVest, and the more I research it, the more I'm like, should make this a larger and larger exposure because the things ClearVest invests in is just crazy, man. We know a lot of those waste companies. They always trade at a premium. For companies like ClearVest, they got this exposure at like an 8 EBITDA or whatever because it's private equity, right? Like obviously stuff's there. It's gonna be a lot more on the cheaper side of it. But I think for everyone like listening here, like allocation is something you need to take seriously, especially if you're 100% individual stocks, which and Fabio, I'm pretty sure you're like what 100% individual stocks, pretty much.
100%. Yeah. Except for my HSA for now until I transfer it.
Yeah. So for a guy like you, allocation absolutely matters massively for the individual stocks. But for a person like me, that's 70% index. I can be more comfortable making 15% more of a higher allocation and being more hyper concentrated. But again, everyone's a different style of investing. Mine is ever evolving over time. I will always like be open to my own mistakes. Like, and it's still really funny. The channel that you called me out on was on Coles. Besides that, yeah, like I
Yeah.
did like
No.
selling has to be me. It's always selling has always been a lot harder for me than it is buying. Because buying is easy. Or like, okay, this is undervalued. All right, I like the numbers
Yes.
here. Selling is so hard because it's like, okay, sure, it might be a little expensive, but like if you're investing in a good company, have good pipeline, I mean, not even pipeline, just like good prospects moving forward, good tailwinds, all that, then is it really necessarily for you to sell? So
Run it this way. So this is I didn't get to say this in the Cole video because we got distracted with another thing, but I was trying to say like the remedy that I came up with. It's not a perfect remedy, but I think it's a good remedy for me. And I'm not telling you to adopt this, but it's a suggestion to think about. Try to do it where you don't sell if it's debatable that it's at fair value. So that has helped me a lot in stopping myself from selling fantastic companies at prices where I'm like, up a lot, right? And doing that now, right, it prevents me from, besides the taxes, it prevents me from selling Netflix, selling a Meta, and kind of saying, well, it's not egregiously overvalued. Like, for example, Netflix at 600, I cannot make an argument. I cannot even get to a place where I'm saying there is value there. I'd be out. But at 300, I can see why someone was saying it's at a fair value. And then same thing with like Meta at current prices. There are arguments out there. There are reasons why someone might say it's at a reasonable valuation. And if I was holding Microsoft, it'd be the same thing. If I was holding Apple, it'd be the same thing. If I was holding, let me pick a non-tech stock, Honeywell, it'd be the same thing. If I was holding, just to name one more, United Health, it'd be the same thing. I wouldn't be selling those under that rule. And I know because I've looked at it. Like I look at these stocks. Oh, Walmart's another one. I wouldn't be selling. Costco, I also wouldn't be selling because I looked at those today actually, and I shared my thoughts with the community in Deluxe. And what I kind of came up with was just a general idea. Like I penciled out what the market was expecting of them, and I think they're more or less like at fair value. And so I wouldn't be selling them.
I think what ended up happening for me was my conviction for Meta simply just kept going lower as the stock went up, if that makes any sense. Because now my expectations are rising as the share price goes up. As the share price is down, as the valuations from my perception is distressed, my expectations for that company is going to be a lot lower. But as the stock price went up higher and higher, my conviction also dwindled a bit. I'm like, well, there could be some competition. there could be some, some interesting competitive battles moving forward from Meta. There is no guarantee that they'll get any sort of augmented reality stuff. There's really no guarantee of that. Apple could easily just be able to control that whole industry just because of the integration of all their products. So again, a lot more questions just started brewing for me as the stock price went higher and the valuation expanded. Like my oldest holding to this day is Constellation Software. That's one I never sold ever. That's one I kept unfortunately averaging up over time. Even recently I was buying it Constellation as well. So no, Apple's trash. But that's the thing. Like, and again, I got a bias towards Canadian companies, obviously, right? Over US tech. US tech is something I've always kind of had a little, I don't know how to say it. It's just
Aversion.
SBC, stock-based compensation turns me off. That's all it is. Like, I really don't like stock-based compensation. And the arguments people use for it, like, for example, I like how Fortinet does it. I think theirs is good because their SBC is very conservative, relatively speaking, to their cash flows. I love seeing that. And they do great buybacks as well. So I love the way Fortinet runs their company. And oddly enough, Fortinet's in moat. Just saying. But
Yeah, I know.
so over other trash cybersecurity companies. But again, that's my biggest gripes with U.S. tech. That doesn't mean I'm like anti-US. Like I've been looking at industrials quite a bit because I love industrials. I love what they do for shareholders, even though some of those companies can be very cyclical or quote unquote cyclical, and there's some seasonality to them. Definitely, there are other industries I'm more interested in for the US, for the United States. US tech, not for me. I rather stick to the Canadian tech companies. So, yeah, that's just my take on all of that.
I want
And that's
to.
yeah.
I want to shout out to Way Too Good. My tech exposure dwarfs yours.
Oh wow, yeah, his is like 100%, bro. Like this guy's like, yeah, bro has Snowflake, CrowdStrike, stock
No,
based.
look, it's to technology exposure is 20% in total.
Oh really?
Yeah, and I think mine's like, Jesus Christ, like this man, Way Too Good. You're lecturing me about getting more involved in tech, and like my guy, like go more in tech. You like,
Oh, yeah.
what are you doing? 20% exposure.
Bro has almost 3 times more tech exposure. Well, actually, more than 3 times, man.
Yeah, I probably have more than that. Which is again why I'm just like, damn, I need
Okay,
to.
so Met. Yeah,
Oh, it doesn't
Meta
consider meta. All right, cool,
all right,
That's good to know. Yeah, it probably puts it in
32,
communication.
32, 40. Yeah, 40%. I don't know, man. You got PayPal. Fucking clown, bro. But it's all good. Wait, was PayPal a new position for you though?
No,
That's different.
Way Too Good had PayPal before, but you look at the exposure, like it's not. He probably didn't even feel that.
Probably not, but PayPal's so
It's bigger than
topic.
it's like a five. Yeah, it's a 5%er, so it's probably bigger.
Okay, topic for another time. Like I'll probably, even though in my video I said never apply PayPal. Like if it hits 40, sure, I'll do a little swing trade on it. Because at that point, it's like, okay, RSI probably oversold, valuation got distressed, or I can do a little swing trade because it's not gonna die. It's just something where, you don't want to be in it for too long. It's
You
not.
know,
It's not a good business,
you
right?
know
I
what's
don't know
funny?
how.
If anyone wants me to
Or should I talk about
highlight,
RSI?
no, you
Whoopsie.
you can talk about it.
And
Um,
no, I keep trading stuff private. But I do use, I don't want to say technicals because fucking retail, bro. Like technical is a tiny, tiny, tiny bit of my process. I do look for certain levels for, to get into a stock, like resistance line and stuff like that. I do look at RSI. I think RSI is a great metric to use. Obviously, make sure you're using a bunch of other stuff and researching. I do. I've had some good success, buying oversold, distressed valuation companies. For me personally, like Intel was a great one as well. Like dividend got cut. All right, I'm in. And then it ran up 30% less than a month. I'm like, okay, got overbought. Bye bye, I'm gone. So, Neighborly Pharmacy, same one as well. New CEO came in, dropped, bought it, and then I sold it after a month because it got overbought 20%. So stuff like that. Again, I use technical analysis, but I'll never mention it on my channel. F that. 'Cause, we all know about the trading courses on YouTube and all that shit. So I don't know.
Yeah.
Technical analysis. Yeah, technical analysis should be like 1% of your process. Um, but man, these people be using it like 100%. I'm like, damn, bro. You don't even know what the company does, and you're just like, oh yeah, yeah, triangle dinosaur lines.
The
Let's
J
go.
Bravos of this world.
Yeah, yeah, clowns, bro.
Yeah, J
What is
Bravos.
that? What's that term? Way too good. Just say, Fabio. What is that? And slim?
Can slim
Yep.
method of investing. I don't really
I
have an
don't even know what that.
educated opinion on it, so
Yeah, yeah. I don't know. I don't know what it
that's
is.
a. I
I
know
literally.
it's almost like it's kind of a cop out, but yeah, I don't have an educated opinion on it.
What is it? It uses strong forming growth stocks.
Yeah,
Uh, I mean,
it's like
I got my.
it's a way to screen stocks, but
I mean, I got my own method. It's called like, well, two methods. Like the primary ones that I use for long-term investing. Number one, and this one I try to avoid saying it because I end up jinxing myself. But winners usually keep winning because they're winning for a reason. And losers keep losing because there's a reason why they keep losing. So don't be shocked if a lot of the stocks you see me buying, the long-term investment side of it, yeah, they're probably winners. Like they're not. I'm not going to be dealing with no 90%. It's just not my thing. But the second one, I do like to look for high ROIC, high current ratio, like companies, lower market caps as well, like lower below 10 billion. That's kind of like the way I go about it. But ideally. So I don't know.
I,
But these other methods I've been seeing are kind of, yeah, I don't know. It's
I
me
look, I
personally.
do agree with you that winners keep on winning, but I feel like we want to be very careful
Oh, yeah, yeah,
because
absolutely, 1000%. Like, look at Danaher, right? Like, common sense valuations is something I obviously implement as well, right? Like, you look at historical valuations and you kind of gauge, and you're like, okay, this might be a little bit like overvalued. Danaher right now, though, I perceive as undervalued, if fairly priced to undervalued. Yeah, that's just me personally. That's a stock that is a winner, but it's a winner that has been severely
Mhm.
underperforming short term. But the long term trend is still there.
Yeah, yeah. There are businesses, the businesses that are constantly just dominating. They're dominating because they have the secret sauce, and so maybe just get involved with them because they have the secret sauce within their sector. Um,
Mhm.
and that's like arguably, I like to say that all the companies that I invest in, that are like the core, they all have that. We can go stock by stock by stock. There are the fun stocks that's I don't really count them. They will or these different ideas that I have. They don't really exhibit those traits, but I would agree that for the majority of my portfolio, in terms of like what I invest in to hold and not sell, yeah, they exhibit those characteristics, and I think that I don't find like when sometimes when I've acquired them, they've been distressed though. And so they are
Mm,
long-term winners. They've been long-term winners, but I think there's some not I think. I've observed that there are moments in time when the market doesn't or it's something strange. Something always comes up. And then you get that period where everyone's just running away from it and they've almost like forgotten it. Or forgotten what it can do. So like, I guess not excluding Meta and Netflix. I hate that. I know that they're being included as like, oh, they're anomalies. It's like, no, not really. they're not anomalies because I've been doing this now for a long enough time. I can point out a lot of instances now where there have been winners that have sold off time and time again that I've involved myself in specifically. Alphabet's been through some stuff over and over and over again. It's kind of wild, and whatever, people have their own reasons to not get involved in it. And if you looked at it from a shorter term chart, it looks like trash because it's down on the year, it's down on the 6 months, it's trending downwards. But I like to ignore. I think I can say this now confidently that I think I can ignore the noise.
yeah. I think another issue why I like sold a lot of the big tech. I already got that exposure with the index investing. I don't really need it.
Oh, you make a good
Right?
point with that. Yes.
Yeah, like the thing is, like, do I really need to have a 3% allocation to Google in my individual stocks when it's already three to like not even it's like 6% with the S&P 500
Mm-hmm.
with
Yep.
the Class A, Class C shares. So again, I'm in a different situation than you. You're 100% stocks. So for you, it makes a lot more sense to be buying a lot of those big tech and making it higher exposure. But for me, it's like I already got this exposure. S&P 500 is pretty top heavy, right? So, and a lot of it primarily big tech. So I just don't need that exposure for me personally. I also invest in SEHG. So that one also, looking for a lot of those growth companies as well, large cap growth. So
Yeah.
again, I got a dilemma. Like it's a good dilemma, but it's a dilemma nonetheless, right? So
Yeah.
that's just yeah.
No,
So
completely understandable. So like, yeah, if you have that exposure and you're considering your index exposure, yeah, it makes sense to not overexpose yourself. Just trying to be, conservative from your portfolio management perspective. But again, like the thing with the whole winner thing, I almost want to say like, I'm not saying you're saying this. I'm saying this more to the audience watching. I like I'm
get it? No, I get it. Like there's certain growth channels. Brian Furley, Molly Fool, those guys. They say terms like that all the time, and they be buying these stocks on the top. My thing is, with when I look at the winners, I do use valuations as well into it as well, and I do look for, um, like short-term fluctuations with the share price. Like if there's any sort of pullback for those stocks, that's when I get into it because I still say, okay, long term they're still winners, doing good. Short term they're having a pullback. Historical valuations are actually getting pretty solid, fair value. I'll get into them now, hoping that the future endeavors are better for the company. But yeah, that's just me. Like for example, Tormont Industries, another one. That's one as it pulled back, I bought aggressively into it. Because I know it's a Caterpillar dealership. It's going to do just fine. It's also an Agco dealership as well. That one is growing very nicely into the portfolio. Still primarily Caterpillar, but Agco is there. Agco itself is only like a 9 billion market cap company, something like that. So, um,
I really
yeah,
like Agco,
Tormont.
by the way, but that's
Yeah, no, no,
irrespective.
yeah, Agco is such a tricky one for me because I already got that exposure with Tormont. So, but I don't know. And again, like with Tormont, man, they're just like, uh, that's such a it's just such a great business, man. They're just like they're a dealership for like every industrial company you can think of, in the rentals segment for the company. But because I know the ATCO exposure, it's like it fluctuates, but it's like low to mid single digits. That's all I got to say there. I like ATCO. I think long term it's going to be good compounder. It has underperformed the last 10 years, but it's still like dividend reinvested. It's still like compounded like more than 10%. I don't know about you, but as an investor, even if you underperformed, if you still have above 10% CAGR, annualized returns, I don't think you should beat yourself down for that. You still did well. It's just, yeah, you underperformed because big tech definitely carried the spy a bit there. But
Yeah, and
yeah, mhm.
well, I
That's
I
my thing.
I think it's not very good to invest always constantly thinking about I need to outperform, I need to outperform. I think that
For
takes
sure,
care
sure.
of itself
Yeah.
if you just follow the other steps properly. Like if you invest in solid companies at reasonable prices and hold them and allow the compounding effect, that over the longer period of time, beating the index can be a byproduct. But focusing on that, because I feel like the other stuff just wears you down mentally. And like the recent performance for the holding co and the personal holdings, I don't do it anything with the explicit goal of outperforming. I'm just simplifying the process a lot more than that. Just buying companies I like at prices I like, done. And anything else, it just takes care of itself. And I'm good with that. It's worked
I
out.
kind of, yeah, I kind of see myself in like a win-win situation where if I do underperform with the individual holding, that's cool because again, primary index, so it doesn't matter. But if I am outperforming the index, great. getting that. I'm getting what my process, I'm getting what I wanted my process to do, which was
Hmm.
to beat the benchmark. But if it doesn't, I'm not losing my brain. Like at the end of the day, I know that I'm 70% index, so it's not that big of a deal.
Yeah.
But it's just, it's definitely a niche. And oh my God, you mean buying most I hate the term moat. I really hate it. The ETF's good though. The moat ETF's good. It's just
Yeah, I know, right? You saw that?
I don't know. I mean, I saw Fortinet. That's the first thing I saw. I'm like,
And
all
then
right,
you're
it's a good
like,
ETF.
yeah, it's a great ETF.
Like, cause me and that the guy that's managing that ETF, we saw similar things with Fortinet. I bet you. Like we saw similar things there. So good stuff. We actually felt like that individual probably saw that Fortinet. Oh wow, they're actually a shareholder friendly company, unlike their peers. But they're growing
Well,
faster.
the
They're more
reason why
innovative. Yeah,
no,
bro.
the reason why CrowdStrike's not in there is because the secondary measure. So primary measure is moat, secondary measure is valuation, price to valuation, and Fortinet probably scores a lot better than CrowdStrike. CrowdStrike
Yeah, 'cause-
pricey.
because and because I think a main driver to that is Fortinet focuses on profitability, but they also, again, with the buybacks, it improves the earnings per share, so it lowers their valuations, and also, I'm just saying, even though it's non-GAAP, it's still a very, very conservative SBC. So, but yeah, I would say like the driver of that EPS is definitely what's affecting it. Um, Strike's just trash. It is what it is, my guy.
Oh, it's been doing really well though
Oh no,
recently.
no, it's been doing well. Before Net's just been doing better. So I don't know.
Is it actually still outperforming Crowd?
Let's see here. Let's type in the two FTNT and
Uh-oh.
yeah, oh, yeah, tiny bit, 43%. Oh, let's go.
On the 1 month, CrowdStrike is outperforming. Let's go.
Yeah, year
Six,
to date though,
six.
and then when we look at the 1 year, 21% for the
Oh
net,
wow,
three
yeah, it's close
negative.
though. CrowdStrike's catching up fast on the year to
Yeah.
date. It's catching up fast. It's
I
now.
mean, we're long-term investors, so you look at 2009, for like a 40 bagger for Fortinet.
Oh,
So.
yeah, yeah. We should. Damn. Fortinet's fucking on fire in the past 5 years. I didn't even realize that.
No, no, that's. I'm definitely regretting not investing in this, but again, I was just focusing at other companies. Um, Cybersecurity is definitely not my strength, so I'd rather not, you know,
They're still
not
founder
play with it.
led, by the way. Well, you know that already. Yeah.
Founder, I don't like that term either. Founder led. I don't like that either.
It's a
A
huge
lot.
reason why. Well, they're both founder led, but Fortinet's founder led as well.
I know most software companies that have been publicly listed relatively recently, like 2018. Most of them are founder led. I looked at a lot of them. They're all pretty trash, but yeah, it's whatever. And again, I'm just saying trash because SPC, like that's my thing. Like they're like a lot like Zscaler. I'm really happy that one has been, performance has been kind of trash on that one. But yeah, Zscaler is one of them where SBC is growing at a higher CAGR than their cash flows.
Yeah, it's
So
ridiculous.
yeah, so yeah, no, you know, they've still performed okay. That's whatever. Just you best believe retail was buying it in November 2021, and they're down like 60%. So
Oh wow, Zscaler is really, yeah, it's really come back down.
yeah. I consider Zscaler and Cloudflare. Well, I would say Cloudflare is probably more degen, just because they don't even make money. But they're both pretty much degen in that aspect of it. I think we've pretty much gone through this debate, right? Like, I mean, well, it wasn't even a debate; it was just
Discussion.
discussion.
Yeah. No, I think it was a good discussion. So it got people counterpoint. It highlighted that you're not supposed to copy too.
I think I highlighted a good amount of stuff. You available 3 p.m. tomorrow? Or no?
Yeah, I'm home pretty much all day tomorrow. I'm gonna
'Cause,
do the Sunday
we're
call and then I'm available.
because we're gonna be doing something fun on that podcast. Second half, we'll be I'll be making the tier list, obviously, but we'll be ranking it together. Berkshire Hathaway's holdings currently, and then you know, future performance and all that. You know, I don't know, it's gonna be pretty fun.
Yeah, no, send me the link and I'll be available.
All right, cool.
All right.
That's
So
good.
with that being said, I'm closing off today's episode, guys. Thank you guys so much for watching, and I'll see you guys on the next one.